Welcome to the Smart Investing Show, sponsored by the SEC-registered investment firm Wilsey Asset Management, a fiduciary firm owned and operated by President Brent Wilsey, who's been putting client needs first for over 40 years. The Smart Investing Show has been giving unbiased financial information for over 27 years on local radio stations right here in San Diego, providing you with fundamental analysis on stocks and investments you want to know about. Now, here are your hosts, Brent and Chase Wilsey.
Well, hello and welcome to the Smart Investing Show. I'm Brent Wilsey, president of Wilsey Asset Management. Great to have you here today. Gosh, we've got a lot of lined up here for you. Great information to make you a smarter investor. We're going to kick off with alternative assets, which I hate. Well, we'll talk more about it, but appears to be a house of cards. We'll explain why. And I can't even tell you. I looked at the fees when you Google it, like, oh my gosh, they're worse than I thought they were. But we'll talk more about that. I like this one though. Tariffs are still not impacting inflation. It's been a couple of months, so we're going to talk about what's happening with inflation. And then health and human services is receiving a major makeover. I think that is long overdue. We'll discuss that as well. And then we jump into some companies. Chase, what companies are we following today?
Yeah, so companies kind of talking about health. We're going to start off actually with Brown-Forman. I don't know if alcohol is very healthy for you, but
that's the opposite.
We're going to take a look at that. We're also going to look at Petco Health, Lululemon, and then DocuSign. So a nice full slate of companies to look at here as well. See if we think it's buy, sell, or hold based off the numbers that we see on air.
And I will say, we'll get to it, but it's harder and harder to find companies to buy. I mean,
about 2 months ago, it was very easy to find companies to buy, and now it's hard again.
Yeah, it's hard again. Yeah, so we'll go over that in the second part of the show. But let's talk about alternative assets appear to be a house of cards. I remember I used the same terminology back before the tech boom and bust not the tech boom, but the bust about 25 years ago. And at the time, I got to say, it was a little bit early, probably like a year or so. But eventually, that house of cards collapsed, as we all know. The more I read about alternative assets, the more I scratch my head like, how is Wall Street getting away with this? And I've always said Wall Street is not on your side. Wall Street is there. There's a lot of greed on Wall Street, and it's there. And these alternative assets are something that I don't know how people can sell them. And they are sold. They're not invested in.
I mean, you talk about this all the time. I mean, it's interesting you talk about like the tech boom and bust, and it's not necessarily the same as that, because at least those were public. People were just losing money publicly, but you used to call them the tenants in common. There's other deals that continued to arise, and it just kind of changes the private rates. It changes the name, but the underlying concern of tying your money up and not really knowing the true value of it, that's the big concern that you have with these alternative investments. There's no secondary market, so it's very challenging. And I just think in the end, I mean, it's the small investor that I think will end up paying dearly for investing in these alternative assets. And it's funny, Harrison and I had this conversation, I think, while you were gone, but we said the problem is we talked about an accredited investor. And it's not that hard now to be an accredited investor, but people hear, oh, the rich people, they're the ones doing these alternative investments, so I should be doing the alternative investments. And I don't think it's going to be your super rich people who get hurt by these. I think it's going to be the small person aspiring to be like a rich person doing these alternative investments, and I think they'll be the ones, unfortunately, that get burned.
And you said there's no secondary market. There kind of is, but I mean, we've had clients come over. It's terrible. It's like a 50% haircut, I think, some of these.
Sometimes it's pennies on the dollar. I mean, it's like some actually. We have one. This guy has a $25 alternative investment, we'll call it, because it's basically depreciated so much, and he has to pay a fee to Schwab every year to hold it, and he can't get rid of it because nobody wants it. It's worth $25. I mean, these illiquid investments, and I'm not going to use a blanket statement, some of them will be okay, some of them will probably have great returns. I'm not going to say
some of them,
but that's the key word. Right. Some of them. Many of them, I think, are going to be a huge challenge for the everyday investor, because you get locked into them. All of a sudden, let's say, hey, I invested in it. I want to buy a house. Sorry, you can't get out of it. I mean, it gives you no flexibility.
And as an example, a company called Hamilton Lane Private Assets can buy, and this is how, again, we're going to dig in deep to this, on how they can buy private stakes from other holders at a discounted price. So again, if it's like a dollar because they're buying it, they got it on sale, they're paying maybe 85 cents on the dollar. Okay, so they got a deal. But they can somehow magically, when they buy it, now they can mark it back up to the value. So somehow that 15 cent or 15% that they discount is gone. So automatically now it's worth more. I don't know how. I don't think they're being looked at very closely yet. I think it's going to take some major losses from the small investor before the SEC gets involved.
Yeah, and I mean, it's just kind of surprising because, I mean, you talked about the fact that they mark it up, but, I mean, it doesn't even matter how they paid for it. I mean, even if it was a competitive auction, why can you all of a sudden create this value essentially out of thin air? Or, again, I'm going to come back to how the small guy gets hurt. Mm-hmm. These big companies, where they're like, they can buy it from the small guy that wants to get or maybe needs to get out of it, and then they get a great deal on it. And they're essentially able to capitalize on the fact that it's illiquid, needing to, I almost said steal, but capitalize off the little guy that needs liquidity.
Capitalize is a good word. Yeah. And I almost will kind of say, it's kind of steal. Yeah. So, and this also reminds me, go back to 2008, the mortgage crisis. They had collateralized mortgage obligations. They were known as CMOs. And I never understood, because what they do, they had these troughs. And they could take like different ratings of different troughs and say, well, these are AAA, these are AA, these are like C. But if we combine them all together, we can say the CMO is a AAA. Well, that made no sense to me. And again, we saw what happened with that. And I don't know how, and I think Wall Street gets away with it because the regulars don't look at it until somebody gets burned on it. Something major happens like 2008. They do that. And I'm just trying to warn clients, if you have, not clients, but listeners, everybody, if you have alternative assets, well, you may be stuck in them. But if you don't have them, don't get them.
Yeah, I mean, there's why would you lock your money away? I mean, honestly, the fact that it's illiquid, I think I need at least a 10% annualized premium over what I would get, because it's like, why would I need to lock my money away for, frankly, many times an undefined period? Maybe it's 5 years. Maybe I've seen some for clients 15, 20 years ago, and they're still not out of them. So it's like, I would need a huge jump up in the rate of return that I would receive, and nobody can guarantee that.
Do you think by chance, when these are being sold, they're forgetting that little detail and saying, oh, this is great, you'll have no market fluctuation, don't worry about it. But the salesperson, I will call them salespeople, not advisors, because that's what they're doing. They're selling these products. They're not telling the whole story. That's what I think is happening.
Yeah, I mean, I definitely think that's the case. We've had people ask us about these before, and they're like, no, they said I can get out. And I'm like, good luck with that. I mean, I don't think that's going to be the case. And as you said, it's that secondary market is there, and maybe you can get out, but at what cost? Yeah. Is the question. And kind of coming back to the accounting piece that you brought up, and this kind of blew me away, but in 2024, there were $162 billion worth of secondary deals with an average discount of 11%. So again, the question is, how can they magically create essentially $18 billion worth of value on those secondary deals instantaneously? I mean, it's kind of like people when they say, my house is worth $1.5 million. But somebody buys it from you, and only somebody will pay $1.2 million. Your house is not worth $1.5 million. It's worth $1.2 million. If the market will only pay an 11% discount, that is what it's worth, not what the essential value is that you can mark it up to in the net asset value. To me, that is just crazy that you can all of a sudden now mark it up to the net asset value, even though nobody else is willing to pay that.
Well, let's talk about the fees, because the incentive fees that private equity firms have, like a Hamilton Lane, they earn from 10 to 12.5%. I mean, just think about that. So for you to break even, they've got to make at least 10% for you to break even. Now, if you want a 5 to 10% return, they now got to do 15 to 20%. I also went to AI and I looked at what do brokers get paid on these? Because we're not a broker, we're an advisor, so we don't sell these. What do brokers get paid? Well, the upfront fee can be as high as 5.5%. That's the high. And then on top of that, there can be an ongoing service fee of 4%, then a redemption fee. I mean, these alternative investments, some of them will have to make 20% before you break even after paying the private equity firm and paying the broker. It's just ludicrous. Do not go into these.
And I'm guessing when they mark it up to net asset value, that's where they're charging their fee. It's not based off the market price. It's just, honestly, again, I want to be very careful in saying they're all bad because I'm sure there's going to be some
Right.
where people have done very well. I mean, I've seen private REITs sometimes work out for people.
Yeah.
And actually did pretty well. Good. I'm happy. But I've seen way more horror stories. And I think fast forward 5 years from now, it's going to be very similar where you're going to be like, oh, I should have listened to the Smart Investing Show and not done that alternative investment.
And again, doing this for over 40 years, I have a lot of experience. Going back to the 1980s, they had a thing called limited partnerships, and only a third or 30% of people made money on those. I don't like those odds. I mean, I want to have at least, an 80% chance of making money, not 30%. That's terrible.
Yeah.
So I think the broken Wall Street makes the most off these alternative investments.
Yeah. So I guess just be careful. I mean, it's just something that you're tying your money away, know the downsides. It's, to me, not worth the risk.
No, definitely not. All right, let's talk about tariffs. Are still not impacting inflation. It's not been a week or two. It's been, a couple of months. A May Consumer Price Index showed little impact from the tariffs. Headline CPI came in at 2.4%, which was right in line with expectations. And core CPI, which excludes food and energy, came in at 2.8%, which was actually below the expectation of 2.9%.
Yeah, and you got to understand here, the headline CPI continues to remain softer than the core CPI due to falling energy prices. Compared to last year, energy prices were down 3.5%, and gasoline in particular fell 12%. Now, maybe that's going to change in the June report. We're going to have to see how this Israel-Iran situation shakes out because we did see a huge surge in oil prices.
I mean, 7%. Did I say that?
Yeah. Crude oil jumped 7%. Right. I think at one point it was up 8-9% on the day. I mean, it was a huge increase. So that could actually be a hit to headline CPI when we see it in July. But we'll kind of have to keep our eyes peeled to see, because then all of a sudden maybe core will look better than the headline.
And I wonder if they include California when they see that decline, that decline in the CPI. Because California, I don't know about you, but I have not seen any decline. And we've talked about this. We won't go into it, but the refinery costs, I'm still paying the same thing I was for gas, I think 2-3 months ago.
And we had a great post on it this week just talking about how California is importing something like, I want to say it's like 425,000 or somewhere along that. Long story short, it's a good amount of barrels of fuel from Asia, because we have no refining capacity here. And not no refining capacity. We have little refining capacity. Right. People are, no, we have a couple of refining. Yeah, you're right. We have a couple of refiners, but they're leaving.
They're leaving. Yeah, so they're leaving. So the core prices do remain a little bit stuck at the 2.8% level, considering it was that level both in March and April reports as well. But considering the concern around tariffs, I would say it's a strong report, because everybody thought like, oh, wait till the tariffs come. Yeah. You're going to see inflation skyrocket. Well, here we are now for 2 reports that there's still no really major sign of inflation. And we do see dollars coming in to the federal government on the tariffs. Yeah, I mean, it's interesting. And then also PPI, Producer Price Index, that also came out this week, and that was still pretty strong as well. Core PPI was actually 3%, and that was down from the prior months at 3.1%. And then the headline Producer Price Index was actually 2.6. So again, we're seeing inflation rates that aren't overly concerning. Now, one thing that does make me wonder is if we don't see the inflation rates, is that going to hit corporate profit margins as time progresses? Because somebody's going to have to pay for these tariffs. And remember, we talked about, we think that was going to be shared all along the line. The transportation company, the manufacturer, the salesperson, everybody's going to share in that. So, but I think you're right, though. There has to be some hit somewhere from somebody. Yeah. Economists. Yeah, economists. I mean, that's another one that I think has kind of been proven to be a little bit wrong so far. And one thing I will give them credence on, and I've kind of been wondering the same thing, and they pointed the fact that companies, they brought in excess inventory before the tariffs were implemented, so they are still working through pre-tariff levels and have not necessarily needed to raise prices yet. The other thing I kind of look at here is it does take time for companies to change their policies and maybe lift prices. So, I mean, there is some potential delay. It's not like, oh, we've gotten through it. We've definitely seen no inflation from these tariffs. I want to be very clear on that. It's still very possible we could see inflation rates increase over the next couple months, because it's just taking a little bit of time to work through the system. But the other thing I was reading from another economist is maybe we won't. And this is where it could be hit to company profit margins. There could be a lack of pricing power, because consumers are tightening their belts and say, well, if you increase prices, let's say 10% for simplicity,
I'm not going to buy that anymore.
Right.
Or if there's a formidable competitor out there, they're like, oh, we're not going to raise our prices. We're going to steal market share at this point in time. So it's very interesting to see how this is all going to play out. We're still very early on, but so far, not much noise, I'd say.
And I got to wonder if inflation does not substantially increase, at what point will economists say that the tariffs, well, maybe aren't as impactful as they once thought? And I do wonder, we're in such a political environment. I think if somebody doesn't like the current president or like the current or the past president, whatever, they will go against that person as opposed to trying to be unbiased. And it's very hard.
Yeah.
But I think a lot of the economists that are saying, oh, it's not going to work, they're against the current administration. But there's other ones out there that maybe say, yes, this is good. I have seen those as well. But it seems to be more on the other side where they say it's not going to be. Maybe they get the most press. I don't know.
Well, a lot of the media maybe does not like the current administration,
Well,
so
that never happens.
they're publicizing maybe more of the economists that are saying the negative things. And I want to be very clear. My personal viewpoint, inflation is not going down because of the tariffs.
Yeah.
But there are other things that are kind of working through the economy. You have to remember, again, we went through a very difficult supply chain change after COVID that created a lot of these issues. We saw a lot of money coming in from the federal government, so you had too much money chasing too few goods. That's why we saw such crazy inflation. That is subsiding. So even with these tariff changes, you still have positive forces on the inflation front that could maybe counteract some of the inflationary pressure from the tariffs as well. So I think it's very possible. I mean, maybe inflation goes up to 3% on the CPI, which to me is not that bad.
The only problem is then the Fed won't reduce rates.
But if it's temporary, if it's transitory on the other side, maybe.
Maybe, yeah. Transitory. Yeah, that word came out, 2022 was
And I'm talking CPI too. I mean, PCE, if maybe PCE stays around 2.5%, I'm not sure. I mean, it's going to be...
Because it shouldn't have an effect on shelter cost, because shelter costs...
Yeah, I mean, you could argue the fact, obviously, you're going to have lumber costs and
Right.
everything else that kind of gets tariffed within the home that would drive up the cost to build a home. So that would have an impact on prices. But as we've seen, home prices haven't accelerated and shelter costs have been a very heavy weight on this report. Well, if it now all of a sudden maybe shelter dips down to 2% and is no longer pushing the CPI higher or the PCE higher, yeah, maybe it actually helps reduce that even with the pressure from tariffs.
And you got to remember, the CPI, there are thousands of items in there, not just five. Say, oh, it's not true because mine this and so. There's thousands of items in there. And do you remember how they calculate the shelter costs? Remember, they changed it. It's like a terrible way of doing it. Do you remember how they do it?
They have 3 or 4 different survey groups that they'll look at. So like you're not even comparing the same group each month. So it's going to take time for that to actually lap compared to the previous year. I mean, it's
based on rents. Remember, it was based on rents, or the equivalent rent, I think is what they call it.
Yeah, so it's rents and then the owner's equivalent rents. So if you're renting an apartment, I mean, that is going to be factored in the CPI. Right. But if you own a home, the price of your home is not factored in the CPI. No. It's what could you rent your home at?
Right.
That is what is factored in the CPI.
So.
And as we just kind of said, somebody thinks their house is worth 1.5, but the market only dictates 1.2. People generally think their home is worth more, and they think they can rent their home out for more than what they can actually get.
My home is always worth the most on the block. Let's talk about health and human services and receiving a major makeover. About time. Back in the 60s, the world looked to America's health regulators for guidance because they had a reputation for integrity, scientific impartiality, and a strong defense of patient welfare. What happened?
Yeah, I mean, that's the interesting thing. And today, and for probably the last couple of decades, the HHS has lost trust among many people. And I don't know if I'd go back the last couple of decades. I really am going to go back to COVID. I think COVID created a lot of question marks for people. I think the vaccinations within COVID created a lot of question marks within people. And now we're kind of seeing the shakeout of people that are making it more political and being like, you are just an anti-vaxxer. And, it's like, oh my gosh, let's just kind of look at things. And I think that is kind of where we need to have trust come back in is, follow the science.
I do remember before COVID. I'm a little bit older than you, so I do remember before COVID. that there was some concerns, but COVID really magnified it. It really brought to the surface. Wait a minute, you're going to force me to get this vaccination? I don't
Force me to wear a mask?
Yes, force me to do 6 foot. And it's so funny how a lot of these come out like, oh, well, the 6 foot thing didn't really help at all. This week, a major shakeup, and this is about time. The Advisory Committee for Immunization Practices, known as ACIP, is retiring. All 17 of the current members on the committee. I love seeing that, like just clean house.
Yeah, and I think it's, again, this is maybe a little bit more political than investment related, but I would personally love, I know RFK, who's head of the HHS, has now appointed 8 new members. Of course, the media is saying they're anti-vaxxers, essentially, along with his agenda. I personally would love to see, 8 members that are maybe anti-vax, so to speak, and 8 members that are pro-vaccine. So then you have this, like, back and forth about, like, what is actually best for the country. And you have to present your data and come to a conclusion that is, kind of agreed upon by laying out all the facts from both sides. But that probably won't happen, That's just my viewpoint, I guess.
I mean, hopefully on the committee, there's people that, want to look at the data to make a decision, not be an anti-vax or a vax or whatever you want to call it, but actually look at the data. Because the reason why it's so important is that we hold in our portfolio medical companies, drug companies. I mean, this is why this is so important to understand the fundamentals of what's going on. When you're investing, you can't just look at the stock price. You got to look at so many other factors. That's why we brought up, this about the health and human services, because it's going to affect some of our companies.
Yeah, and I mean, the thing that we look at, too, is in the past, the committee had many, like, persistent conflicts of interest and approved this just blew my mind. They approved every vaccine that came through. Not one had question marks. Not one was bad. I mean, it's kind of interesting. And also the committee met behind closed doors and without transparency, so the public had no faith in their decisions. And part of me is like, gosh, remember how the Federal Reserve used to not really say anything? They would just do it. And now the Federal Reserve, it's like, gosh, there's a board member talking, it feels like every single day about what's going on with rates. It'd be interesting to see if we get more transparency into other areas of the government. And I know the Federal Reserve is independent, but, I'd still consider them part of the government. It'd be great to get a little bit more transparency, I guess, on some other areas.
And Chase, gets even worse. Some of the members had financial stakes or received substantial funding from the pharmaceutical companies. Like, that is so biased that, okay, so if I got a financial stake in your company, all right, we'll get you approved. I mean, it's just that good old boy network, that just doesn't work. So I'm glad to see that that's going to be gone. They should have many times in companies, you can't hold certain stocks because there'd be a bias to it. Well, I think these guys on this committee, they should have no healthcare companies, no pharmaceuticals, nothing, no stake to them at all.
Yeah, how is it right that maybe you have a stake in, and I don't know their exact holdings, but let's say you do hold a stake in Merck, and it's like, ooh, they're up for a new vaccine. Let's see, if I don't allow this, that could plummet the stock 10%. Yeah, I don't know if that makes much sense to me. But I guess the positive here is there are changes occurring, and hopefully they are for the best. And, I think good science is very important. So hopefully this does improve the threshold for strong vaccines, strong medical systems, strong, healthcare in this country. I mean, that should be the ultimate goal.
Yep. And this could have an impact on some pharmaceutical stocks if vaccines go through a more rigorous approval process. And that's why we talk about it, because if you have medical companies in your portfolio, you understand what's going on.
Yeah, so I think it could be beneficial. I mean, instead of having maybe more competitors, it's going to be the best that truly survive.
Yep. This all comes to our newsletter, smartinvesting2000.com. That's where you get it. And we got other ones in there as well. Yes, the rich are getting richer. The disappointing Cybertruck from Tesla. I loved that one when I saw it. Shocker, California continues to struggle with gas prices. The tidal wave in Bitcoin continues to build. A hot summer is going to lead to higher utility prices. The sun is setting on solar companies, all at the website, smartinvesting2000.com. Again, that's smartinvesting2000.com. I almost picked the Cybertruck one from Tesla. Pretty interesting.
There's some good ones, yeah.
Yeah, so let's talk about companies before we get to the break here. I want to talk about Brown-Forman. Gosh, the alcohol industry is really having some difficulties here. Beverages, they're in the industry of beverages, wineries, and distilleries. No concern yet on the short side, only 0.2%. Well, this is strange. And again, we saw 2 shares on stock. We almost didn't do this one because of the Class A and the Class B. It only shows 12% institutional ownership on the Class A shares. So,
On the Class A, I'm looking at the Class B because I don't have data on the Class A.
oh, you know what? On my screen here, it came up Class B. So
Are
something.
you Class B or Class A?
What shows Class A? I don't know.
Oh,
who,
okay.
Yeah, somebody put on Class A.
The
for me.
valuations will still be the same, though. The
Yeah.
company's underlying fundamentals should not be different.
I just switched over to Class B.
Perfect.
So, okay, now it's a different story. Now short is 9.7%. Institutional ownership is 66.3%, which is pretty low. The PE ratio does look good, though, 14.4 versus 26.3. Price to sales, 3.2, above the industry at 2. Price to book value, 3.1 versus 2.4. Price to cash flow, 21 versus 12. No PEG ratio, so you really don't know what you're paying for the future growth of this company. Now, Brown & Forman actually is doing okay, and I say that because their earnings only fell 2.3% over the past year. Industry down 24.1% over the last year. Sales declined by 3.2%, which was worse than the industry at a negative 0.7%. 5-year growth rate for Brown-Forman from the analysts is only, well, it's a loss of 0.7%. Industry 1.3. They do pay a dividend here. They pay a 3.4% dividend, use 42% of their earnings to pay that out. Taking a quick look at the balance sheet, wow, current ratio 3.5 versus 2, so a lot of liquidity. And the debt's in check as well at 0.8 versus 1.3. They do have a nice net profit margin, 24.5%, well above the industry at 10.8. Return on equity is 25.9 versus 21.6, and free cash flow $534 million versus 1.5 billion for the industry.
Current price here for Brown-Forman, again, their ticker symbol is BF.B, $26.44. They actually did hit a 52-week low today at $26.33. 52-week high is $49.89. Stock has just not been a good performer. The last 5 years, down about 60%. Last 10 years, down about 32%. Going forward, I go out to April 2027 as they do report on a fiscal basis. I see estimated earnings per share of $1.75. Gives us a target sell price here of $29.05. So I'm going to say just slightly above that current level, about 10% above that current level. I don't think at this valuation the risk is worth the reward. And they do, Jack Daniels, Woodford Reserve. They're very heavy in the whiskey. The problem is if people are drinking less, whiskey is a very long-term investment because you have to age in the barrels. Clearing out that inventory is going to be a difficult challenge if drinking continues to remain as light as it has been.
Yeah, drink the scotch, but don't buy the stock.
Yeah.
So, do they do scotch? I don't know.
I think whiskey's their big
Whiskey's
thing.
Okay. All right, we're going to take a quick break. When we come back, we got our financial planner, Harrison Johnson, coming up. So stay with us. We'll be right back. All righty, welcome back to the second half of the Smart Investing Show. This is where we talk about, we bring in our financial planner, Harrison Johnson, CFP, talking about what if there's a recession while in retirement? Go back to work? What do you do?
Well, there will be a recession in retirement. That's the point I'm getting at. And
Yes.
As before you started talking, I was just thinking, how long have you been doing this, Brent?
Probably about 43, 44 years, I think.
So that's a long time. And
Are you
it's
saying
one
he's
of-
old? Yeah.
well,
Experience.
That's not the point I'm making.
Experience.
But it's
There we
not
go.
it's not inconceivable for somebody to have a retirement that lasts that long. I mean,
Right.
if you retire in your 50s and you live into your 90s, you could theoretically have
definitely.
a retirement of 40 years. So in that 43 years, how many ups and downs have you seen in the market?
Oh, I mean, I saw the 87 crash. I saw the banking crisis. I saw the tech boom and bust. I saw the Great Recession. I saw COVID. So over 40 years, you could have maybe 5, 6 recessions.
And those are the big ones, you
Yeah.
know, not to mention, corrections or bear markets or things
Yeah.
like that. So the point is, just because you're going into retirement doesn't mean you're not going to experience that anymore. So people say, well, what if I retire and then I go through a recession? And really, it's a matter of if and not when, or it will happen. So it's
Yeah.
not a matter of if, it's a matter of when. So that'll happen probably many, many times.
You did put in your note here, what if?
What if? And so, yeah. So, well, what if it happens to me? Because people ask that question, and my response is it will happen. And I was reading earlier today, and right now, 8 in 10 Americans are changing their spending habits due to economic concerns. 58% of people expect a recession. And so, a lot of people who are preparing for retirement, that might be weighing on them on when they will actually be able to retire, or maybe they've just recently retired and they're really nervous about it. But again, the point is there is going to be ups and downs. And when you go into retirement, you have to have a plan and an income stream and different investment allocations to make sure that it can weather that. So just because there is volatility doesn't mean that you can't retire. You just need to make sure that you're very conscious and diligent of the things that you're investing in so that when that does happen, you can still have the cash flow that you need to survive and live the retirement that you want to.
Now, as a financial planner, you pull together everything for people. What do you do to try to help them feel more comfortable? Because as you said, it's going to happen. So how do you say, like, it'll be okay? What do you do?
Well, part of it is you need to make sure that you have enough liquidity. I mean, when you think about people going through volatility, what really hurts people is if they're withdrawing from an investment portfolio and they have to withdraw money even if it's not the best time to do that. So if there's a downturn and you have to sell things off to generate cash so that you can withdraw, and if you withdraw too much, you don't have the ability to go back up. So you need to have the right amount of liquidity to hold on to that. You also need to make sure that of the portfolio that you're using for income, you have a sustainable withdrawal rate. You can't be withdrawing 15% of a portfolio and expect to not to run out of money at some point. So the withdrawal rate needs to be appropriate, and you also have to be okay with investing money. I mean, some people get to retirement and they think, okay, now's my time to be conservative. I'm going to retire in 3 years, so I have a 3-year time horizon. No, you're probably going to live for another 30 years. That's your horizon. That's the investment decisions you need to make should reflect the rest of your life, if not longer, not just until you get to retirement, because you always should be investing. And the only way to avoid volatility is to do things like hold cash, which means everything else around you then is getting more expensive except the cash that you have. Or, people will go buy annuities because they're afraid of volatility, and you're better off just holding cash at that point in many cases. So
Hate annuities.
I was going to say, too, when you mentioned a realistic distribution rate, and one of the things that I think really hurts people, and they don't realize it long-term, the impacts, is, we see this with some of our clients, and they really put themselves in jeopardy, is when they're taking income and they take distributions on top of that distribution rate. So it's like, yeah, let's say you're taking $5,000 a month, and then you call up and say, hey, I'm actually going on vacation. Can I also get like a $30,000 on top of that? That is a really dangerous thing, and that's where I think the planning is so important, because you don't realize that $30,000 withdrawal now all of a sudden lifts your normalized distribution rate, and you can now really accelerate you running out of money.
It's better to look at, if you're withdrawing money from a portfolio in retirement, you almost want to think of it as a paycheck. Yeah. So, okay, I've got this portfolio. This is how much I can reasonably withdraw. If I do more than that, now I'm running the risk of running out of money at some point. So whatever you reasonably can withdraw, if you want to plan a trip or buy a car or whatever it is, it's got to come out of that money. Yes, you technically can access more if you want to, but you just run the risk of potentially running out.
And Chase, you bring up a good point, because we've had, our income program now for over 25 years, 6% distribution rate has worked very well for clients over that time frame. The ones who it don't work out for are the ones like, well, I just want to go to Europe and take out $25,000. They don't realize the compounding effect of that money long term, and it destroys their plan. You've got to have a solid plan, and that's why, again, as a financial planner, you're like their coach to keep them on track.
And, you bring up a good point, Brent, because honestly, if you have an investment portfolio that you can withdraw 6% from that a year and not run out of money no matter how long your retirement is while still preserving that money, I mean, that's a fantastic retirement plan to be able to do that. But as Chase said, if you're withdrawing more periodically, that 6% annual withdrawal rate really is now 12. Now that's a little bit harder to sustain. Yeah. And, if you don't have that long of retirement, you might be okay. But if you live, 20, 30, maybe more years in retirement, the chances of being able to withdraw 10, 12, 15% of that without running out, no matter what you invest in, isn't very good.
And I think the defined contribution plan, most commonly referred to obviously as the 401k, is the most common defined contribution plan, I guess is the way I should say it, is far better than the defined benefit plan or a pension plan because it gives people more control. It gives them ability to actually, I think, retire sooner because they can then front load it. They can actually, again, control their retirement. But the problem is with the defined benefit plan, nobody ever thought about like, oh, okay, great, I'm getting $5,000 a month from my pension. Oh, can I withdraw $25,000? No, that wasn't even an option. You just had the money coming in. You had to still budget that money and then utilize that money as you would if you were working. But I think sometimes the 401k, people see that big lump sum and they take the income, but they're like, yeah, I mean, I'm getting $5,000 a month, but I still have like $500,000 there.
That's my money. I can take it if I want to. Yeah.
And that's
it's
where
true.
it's dangerous.
It's your money to lose too. So, which I mean, a pension is really an annuity at the end of the day, and if you have that,
Don't use that word.
I know, well, an annuity, the textbook definition of an annuity is just a stream of cash flow, which that's what a pension is. And if you have that, you can't run out as long as it pays for your lifetime, but you don't have the flexibility or the freedom. Now, sometimes you give people freedom and they, have the freedom to make the wrong decisions, like withdraw too much money or spend it all or invest poorly or whatever it is. But if used correctly, it can, be a lot better.
Yeah. This is why I think people should have a financial planner to keep them on track because you need somebody there. And they're like, yeah, I can do it myself. With a financial planner like yourself, a CFP, you can give them the facts and say, no, shouldn't do that. Don't do it. This is what's going to happen if you do that. So it's not emotional. It's very
and there's always going to be changes. People's lives change. The world around you changes. So just because there's changes doesn't mean that the plan that you have doesn't work anymore. I mean, if you think of it like a map, okay, if I'm going to drive from San Diego to, Northern California, there's lots of different ways that you could get there. And, you might go on different detours and things, but you're still going to end up in that place. But, I can kind of help people stay on the most efficient path, essentially.
Right. All right. Well, Harrison, thank you very much. Again, that is Harrison Johnson, CFP. He is with Wilsey Asset Management. If you want to have a free consultation with him, talk to him, give a call on the phone, 858-224-0004. Again, that's 858-224-0004. Or go to the website, smartinvesting2000.com. That's smartinvesting2000.com. Send them an email right there, and you can start that dialogue to get your financial plan on track. And if you don't have one, you need to get it. Get one going, maybe.
It really helps. I kind of tie it back into the beginning. Again, going through recessions, having a plan in place for those recessions that will come about, as he said, I think really helps people through the difficult times that, again, will come about.
Yep, exactly. Well, let's talk about, Petco Health and Wellness. Now, Petco is like, I want to buy the stock because, I love pets. I love my dog. Let's tell you what happened with Petco. Their symbol is WOOF. Question is, should you buy it now? Well, we'll go with the numbers here for you. They're in the specialty retail industry. Short float, 30%. 30% of the shares are shorted. We do see that they have no PE ratio versus 19.8, and that's for the industry, as again, specialty retail. Price to sales looks good, 0.1 versus 0.7. Price to book value, 0.6 versus 3.4. I will point out there's no price to tangible book value, so that would be a problem. Price to cash flow looks good, 4 versus 8.6. They do have a PEG ratio of 1.6, which is surprising to me. No earnings over last year. Sales were down, not by a lot, down 2.4%. Industry was up 3.1%. Well, this is a shocker. The 5-year earnings per share growth estimate from the analysts, 19.7. They're looking for a big turnaround in this stock, and I don't see why. I'm not getting it. They do not pay a dividend. Let's take a look at the balance sheet here. Current ratio, 0.9 versus 1.6. Debt to equity, 2.6 versus 1.3, so that's not good. We don't like a debt to equity above 1.4. They also have a lot of intangible assets. 39% are intangible assets. Net profit margin, a negative 1.1 versus a positive 3.4. Return on equity, a negative 6 versus 21.4. Free cash flow, 47. I think that's probably 47,000 maybe versus a 1.3 billion.
Probably 47 million.
Yeah, probably 47 million. Yeah, 47 million. What do you got, Chase?
Yeah, so current price here for Petco, again, their ticker symbol is WOOF, is $2.47, and woof. the performance has been terrible.
What a dog.
The year-to-date return down 35%, and it looks like, gosh, they kind of became. I know they were public. They went private, then they came public again. Back in 2021, it looks like the stock was around $27-ish a share, and since then it's just been downhill. Just not good for shareholders of Petco, unfortunately. But going forward for the business, we go out to, let's see here, January 2027. This is interesting. Estimated earnings per share here of 18 cents. It gives it a target sell price of $2.99. So the forward PE is actually under 14.5 times. And this is kind of what parlays into the huge EPS growth rate that you said. They're looking for earnings per share growth from 2026 to 2027 of 99%. So what is changing with this business that is allowing them to all of a sudden produce higher earnings, yet sales are actually estimated to only climb by about 1.4% that year?
I don't get it. I'm scratching my head. I'm going to take a quick look at the balance sheet to see here, because I think this company is just laden with debt here. I don't know why you'd be investing in this company. And yeah, it sounds good. Like, oh, $2.50 to get the stock for. What a great deal. Let's take a look at their debt. They got long-term debt, $2.6 billion. That's not too bad. Their equity is they even have equity of $1.1 billion.
I'd be curious, I guess, a little bit more on their debt coverage ratio. So can their cash flow cover their interest? When is that debt coming due? I mean, I would never buy a company of this nature because, again, I just say the debt to equity is 260%. That's just way too high for me. But if this company did find its way out, I mean, this could be a huge gainer. But again, that's a huge risk. That's not how we invest for our clients, for our personal selves, because your options are the stock goes way up or it goes to zero. Yeah. And I don't like to play that game. And I was going to say, on a personal note, I went to the Petco in Poway, actually, for the first time probably since I was a kid.
Oh, yeah.
And they totally revamped the inside. They kind of made it look more modern, I would say. But I was so disappointed. I took my daughter there because we wanted to take her to go see, like just some animals, like maybe some fish. And they had like no animals there. What? There was no fish. There was no like cats. There was no like turtles, or a very small selection of betta fish was the only thing we saw there. And I was like,
well, she was disappointed.
Yeah, she was not happy. She did find these little toy dinosaurs at the front, so at least she got a little enjoyment out of that. But
they used to sell that stuff.
Yeah, and I don't know if that's just the Poway location, because they did have, they maybe more grooming, and they had the vet health, or right. Vetco is what they call it, I guess. They had that in there, so I wonder if they had to kind of peel space away to take care of that. But I don't know if that's a idiosyncratic in terms of that one location, but I was definitely just kind of disappointed from the standpoint of it didn't accomplish what I was hoping for.
Where would you go buy a pet and fish and stuff like that then? I mean, because I've gone into Cahoots when I had a dog, and they didn't. I don't think they had it there either.
I don't know. Yeah.
I maybe that's not where the money is, but not helping out Petco.
Yeah. They gotta figure something out here, though. Otherwise, I mean, I was blown away by this. The market cap is now $725 million. I mean, I definitely thought this was a company just by the name alone that would at least be a multi-billion-dollar company, and again, pretty small.
And this is again why we say, people say, "Oh, buy what you know." No, you don't know this company just because you like dogs or cats or animals. You don't step in and buy a Petco because of the fact that it appears, I mean, especially if you bought it 3 years ago, you've lost about 85%, I think, of your money.
And this is a long shot, so please do not buy it because of what I'm about to say. But the only thing that I could see saving this company is a GameStopification of this company.
GameStop, you're bringing them up.
Because when you look at it, GameStop was very similar. It was a dying business. Cash flows were declining. They were running into issues. And then all of a sudden they had this huge short, Petco, huge short. Then all of a sudden you get this huge short squeeze. Company starts issuing stock to pay off debt. That is like the only thing I can see that could really be a big benefit to Petco. But that is a far reach, and I would never base an investment thesis off of that.
Yeah, that's definitely a gamble. I think your odds would be better at the craps table in Vegas than buying Petco, but be warned. So, well, let's move on to Lululemon. And this has been a very popular company for years. But they seem to be struggling a little bit. They're in the industry of apparel and retail. Their symbol is LULU. 5.5% short. That's not too bad. 97% institutional owned. They've got now a reasonable PE. I know there was a time they had a very high PE. It's now 16.3, still not as good as the industry at 13.4. Price of sales is 2.7 versus 2.1. Price to book value is 6.7 versus 6.3. Price to cash flow 14.5, better than the industry at 16.1. They do have a PEG ratio of 3.4, nothing for the industry. Now, over the last year, their earnings, well, they look like they're okay. They were up 18% above the industry at 12.1. Sales over last year up 9.4% versus 7.7, so did well there. The 5-year growth rate on the earnings per share going forward is 5.5%. The industry is a negative 7.9. They still do not pay a dividend. They're still, I guess, considered a growth company. The balance sheet, current ratio, very good, 2.3 versus 1.8. Not much debt. Debt to equity is 0.4 versus 0.8 for the industry, so that's a positive. Net profit margin is 16.8 versus 8.3. And I know those pants and clothes are pretty expensive. They're making about 17 cents in every dollar that you get there. And wow, the return on equity is 42.1 versus 32.3. So that's pretty good. Their cash flow, free cash flow, was $1.3 billion versus $3.8 billion for the industry. What do you got going forward here, Chase?
Yeah, I was gonna say. I mean, the stock actually pulled back pretty drastically after earnings last week. It looks like it was down about 20%, as the outlook is actually what missed expectations. And I mean, this has caused the stock to be now down about 37% year to date.
Oh, wow.
I was kind of surprised by this. We know it hasn't performed well, but the 5-year return now negative 21%.
That's a surprise, too, because I thought they've done well over that time frame.
Yeah, and obviously not. But the 10-year return up 274%. So the interesting thing is that means if you bought this stock 10 years ago, the first 5 years were great, but now the last 5 years have been terrible. What's even worse is if you saw somebody, one of your friends bought it 10 years ago, and they had done so well after 5 years that then you bought it. Well, now obviously that
happens a lot. People, I've done so well in this. Yeah, you should buy it. Like, yeah, you paid a much lower price than I did, and that can hurt your investment performance.
Yeah, and what we're looking at here is now that current price, 239.11 compares to a 52-week range. The low 226.01 and the high here $423.32. This company now finally has a target sell price that is actually above the current price. And I don't know if I've ever looked at this company and having that be an option. Still not a buy yet, but the estimated earnings per share for January 2027, $15.77, gives you a target sell at $261.78. Forward PE still about 15.6-ish, 15.5-ish. So it's still, again, expensive. We like to buy things around 12 times earnings. And frankly, I wouldn't buy this company even though it's below our target sell price, because the growth is terrible. I would need this stock definitely around 10, 12 times earnings. Earnings are estimated to grow this year about 1%, next year by about 6%. Sales, they're not doing much either. I'm going to say about mid-single digit growth is what the expectation is. You're not getting much growth, and you're getting, again, not a cheap multiple for buying this stock.
And I do see the last 9 days that the estimates did come down quite a bit. Looks like they fell, well, not quite a bit, I guess by about 6.5%. So those estimates are coming down, will continue to decline. And I got to ask the obvious question. Lululemon was hot a few years ago. They did, probably about 5-6 years ago, did great. How many pairs of Lululemon pants can a woman own? That's a dangerous question.
Wow, totally off track here, but I just asked ChatGPT. I was curious because one of the other things I read was the fact that they're going to have to mitigate the impact of higher tariffs. Approximately, this is what ChatGPT is telling me, approximately 67% of Lululemon's products are manufactured in China, with the remaining 33% produced in countries such as U.S., Canada, Israel, Taiwan, Indonesia, and India. So that is going to be a problem for them if tariffs remain an issue. But back to your question about leggings.
I thought you were avoiding the question. You don't want to go there.
No, I mean, my concern is not even how many leggings can somebody own. That Lululemon also does men's clothing. I have a few friends that said super comfortable, great shorts, great shirts.
I don't think they have much sales from. When I walk by there, I don't go in there. I don't see many men in there. It's mostly women. But you think we can find that real quick? Is that what you're looking at there?
I'm going to see. I mean, we'll see.
I still say it's like a woman's brand. I'm old school, but
I mean, my point was going to be that there's now so much more competition. You have Viore, which has really taken off, and they're not a public company, but even Jim Cramer, after I saw this, and I think they actually started here in Carlsbad, if I'm not mistaken. Viore did.
Oh, really?
And had already made it all the way over to New York, where Jim Cramer's talking about it. So I mean, that is true competition for them. Alo Yoga, my wife really likes them as a brand. I mean, there's just been so much in this athleisure space that, back to your question, how many Lululemon leggings can you own? Well, how many leggings can you own? There's so many different options is the big problem.
I think my wife has almost every option. I go with those new? Yeah. So, but as a whole, I'm just wondering if it's kind of surpassed it. That's why they probably brought the men's products, because they had to expand. You can't have women keep growing that, so they're trying to get the men involved as well. But it's just, they had such, I think, a hit with those leggings years ago that the fad seems to be changing.
Yeah, and it looks like about 23%, which is higher than I thought it would be, of the total revenue in fiscal year 2023 came from men.
Yeah, I am surprised on that.
Yeah. And the issue is, as you said, you have to keep growing. And I'm going to guess this stock years ago was trading around 40 times earnings, 50 times earnings, something crazy like that. You have to keep looking for growth. And all of a sudden you start running out of areas to grow. That growth rate falls like we saw here. Then the stock plummets because that valuation contracts. Even though they're still growing earnings, it's at a much slower rate. So you can't justify that higher multiple. And you see that the stock plummets. So even with that lower price compared to the target sell price, I would stay away from this, because I mean, we didn't bring up Nike and the traditional, I'm going to say, legacy athletic companies. I mean, they have other competitors to Lululemon as well.
So they got a lot of competitors. They've got perhaps saturated market, and then they have the China issue with the tariffs.
And I don't know where their growth would come from now.
Yeah.
I think it's going to be difficult. If this stock traded at a multiple of, let's say, 10 to 12 times, I think this would be a very intriguing company, because I don't think it's going to go to zero, but still remains expensive from my viewpoint.
Yeah, I don't. Big factors of growth, and I think they will. Obviously, leggings aren't going away, but you're not going to have that type of growth they had when they were the only legging company on the street. And I think they're the ones that kind of came out with it. They started the fad years ago.
Yeah, I mean, I don't know if leggings were around before that, but I think they definitely revolutionized it to really kind of put it on the map. And I mean, they definitely did a great job, and it's a great company many people love. It was just way too expensive of a stock for many years.
Yeah, that's why we said don't buy it. And if you bought it, you're down, what was it, 20% or something over 5 years?
This year down 30, 5 years down 20. Right, if you would have not listened to us 10 years ago and bought it, you're still up about 270. But you should have sold it 5 years ago.
There we go. Well, let's talk about DocuSign, our last company for the day. DocuSign symbol is DOCU, then the software application industry. This was actually another hot company. Short on the float is about 4.5%, 87.2% institutional owned. Wow, PE ratio 14.1 versus 84.4. Maybe we got something here, a tech company we can buy. Price of sales 5.2 versus 6.8. Price to book value 7.4 versus 7.1. Price to cash flow 15.4 versus 32.2. And pay ratio 1 versus 10.9. I said a tech company. This is what they call fintech, I think, right? Is that what you call this company?
I don't know if it'd be fintech. It's not in finance, but
what do you call this company?
I don't even know. I mean, it's it's
software,
a technology software. Yeah.
Software applications. So I guess that's where we should look at it there. On the earnings, wow, up 916% over the last year. Industry up 10.6. Sales up 7.9 versus 9.7 for the industry. 5-year earnings per share growth estimate from the analyst, 21.5% versus 8.8. So things for DocuSign still looking good. I know we use it here a lot. I see it come across my desk a lot. The balance sheet, 0.8 on the current ratio versus 2. That could be a problem. Debt to equity, 0.1 versus 0.5. That's a positive. We do see a net profit margin, 36.5 versus 10.5%. Return to equity, 54.9 versus 15.6. Free cash flow, $916 million versus $2.9 billion for the industry. Chase, what do you got?
Yeah, so current price here for DocuSign, again, their ticker symbol DOCU. It's $74.06, 52-week range, kind of been all over the place. The low here is $48.80, and the high $107.86. But this was, again, one of the COVID darlings, I'll call it. It eclipsed $300 per share back in 2021.
Wow.
So, I mean, it's definitely kind of fallen from those good graces essentially to a much more, I'm going to call it, realistic price. The other thing that I look at with DocuSign is the fact that it's still a little bit expensive, unfortunately. I was kind of disappointed by that. But you go out to January 2027, estimated earnings per share, $3.89, gives you a target sell of $64.57, so still trades around 20 times earnings. And, I mean, you look at it, they had a pretty big fall after reporting earnings. They cut its full-year billings forecast, which I assume is kind of like their revenue. The stock plunged about 19%. But I think a big problem why it had such a negative reaction to that earnings print was over the last year, even with that big decline, it's still up 44%. So I think it ran way too far ahead of itself and, kind of didn't live up to that expectations. And again, it still looks expensive even at these current levels, unfortunately.
And I know there's not much of an increase from 2026 to 2027 on the earnings estimates. I'm wondering if that's because of the real estate. I mean, real estate has definitely slowed down. We talked to realtors. Yeah, well, not some as much as we used to. And I think DocuSign is really big on that. We use it. I mean, more of the operations of the...
Yeah, I know Charles Schwab, when we send out applications, they'll use it. I do know there's other ones out there now, too, though, like Adobe Sign. One of the firms I work with, they use this company called HelloSign. So I'm not sure how much of the market they control, but I'm pretty sure it's a large percentage.
Gosh, I was surprised by that closing bell. I thought we had more time. Gosh, I enjoyed that topic. But that is the closing bell. Thank you for listening to Smart Investing Show. It is for informational purposes only and should not be used as investment advice. If you'd like to discuss in more detail your investment needs or have other investment questions, feel free to give myself a call, Brent Wilsey or Chase Wilsey at 858-224-0004. Again, that's 858-224-0004. Or go to our website, smartinvesting2000.com. Again, that's smartinvesting2000.com. A lot of great information there. You can sign up for the newsletter. A lot of great things there. Thanks for listening. We'll be back next week right here on the Smart Investing Show.